We are pleased this morning, Becky, to be joined by Beth Hammack, the new Cleveland Federal Reserve Bank president, ex of Goldman and all kinds of fun things. Welcome, your first television interview. Welcome to the conversation, I'd like to say.
Thanks for having me.
So let's start right away. Let's get into it. The morning the durable goods number came out, up 0.1% on the investment side. What are you hearing about how the change of policy is affecting the companies in the context you're talking to?
Well, thanks for having me, Steve. It's great to be here. One of my favorite parts of the job of being Cleveland Fed president is going out in the district and talking to companies, talking to businesses and understanding how they're thinking about things. What we're hearing right now is that the uncertainty is really weighing on businesses, and it's creating issues for them in terms of planning, in terms of thinking about where they're going to go. And so some of them have put pauses on whether they're going to make bigger investments, whether they're going to invest in new facilities, new capital plans. And then they're thinking about their hiring plans. They're thinking about their labor force, and do they have the people they need? How many people are they going to be able to keep on for what length of time, given what these changes might do for their businesses?
What is the macro effect of this? If people hold back now, what does that mean for the economy now, and what does it mean for the economy in the future?
It's a great question. We don't know the answer to that. I wish I had a crystal ball. We don't have one. I think everyone is trying to work through what the implications of these tariffs and these policies are going to be, how significant the tariffs are going to be, how long they're going to stay in place. And if you're looking at building a new facility, building a new plant because you want to bring back production into the U.S., you need to have confidence that those policies are going to be in place for a long period of time. It can't just be 2 or 4 years. It's got to be 10, 20, 30 years to get that capital investment to make sense.
When you put it all together, there are people, Torsten Slok from Apollo, other J.P. Morgan as well. They say if these policies stay in place, there are 60, 70, 80, Torsten's even 90% chance of recession. What's your outlook?
I'm not really operating with a base case right now. I think the cone of possibilities is so wide.
When you say base case, that means you have no sort of odds-on bet in what you think.
I'm looking at scenarios.
Right.
I'm trying to break the world into different scenarios of what could happen. If we see businesses really start taking the tariffs and it impacts their input costs and they have to raise prices significantly. If we see pricing going up a lot, but we don't see an impact on growth or labor, then that could be, inflationary. But it could be, like one of my colleagues says, that the tariffs could be just a change in the price level and that it's not going to be persistent. And it could be that we see actual, weakening in the labor force, weakening in growth, and that would require a different set of policies. And it could be that we have the two sides of our mandate in conflict, which is the most challenging for monetary policy. If we see higher inflation and lower employment, that's where things get really complicated.
How long do you think it will take you to kind of suss out which one is the more important? Because my guess would be that you'll have someone in the Oval Office who is watching very closely when you all meet next month to see what happens. Is it crazy to think that it's too soon, or is it crazy to think that a decision could be made by that point, that you will say, okay, we know enough about what's happening here?
So I think it's too soon. I think we need to be patient. I think this is a time when we want to make sure we're moving in the right direction than moving too quickly in the wrong direction. And so I would rather take our time, make sure we're looking at the data. The hard data that we've come into this quarter with are actually really good. Right. You've got unemployment right around 4.2%. That's right around full employment. Inflation's continuing to come down, right around 2.5% on PCE. So we've seen good things in the hard data. The soft data is more concerning. A lot of the surveys have shown more worrisome, more struggling with, exactly what things are going to mean. We're seeing that in the Beige Book that came out yesterday. You're hearing a lot of focus on tariffs and uncertainty. And so, to me, this is a good moment for us to take our time and make sure we're moving in the right direction. You've seen that this is not a Fed that's afraid of moving quickly if we need to move quickly. And so if we have clear and convincing evidence by June, July, September.
But afraid to move preemptively. That's the thing. And I know how hard it is, but saying I want to wait and see. Let's say the tariffs, and we've seen when the stock market acts a certain way, it seems like the tariffs become less certain that they're going to be here for a long time. So on the one hand, you say that you might not get to the second derivative. It might be a one-shot deal. We might not even get the one-shot deal. We might not even get that. But we do seem to have a lot of uncertainty. I think I can already say I think the risk has shifted much more to a growth risk than inflation. We had some really soft inflation numbers already. If you really want to be preemptive and be the greatest Fed in history, to actually anticipate something instead of reacting to it, you would cut soon. Did I convince you? You're going to vote for a cut?
I'm not voting this year, so it's an easy year for me.
Next year, then, right?
Next year we're voting again. Look, I think the Fed has proven that it can be preemptive, and it will be preemptive when it's clear what the right action is.
When did they prove that?
In 2020. I think in 2020, when you saw the onset of the pandemic.
Inflation, though. Oh, okay.
When you saw the onset of the pandemic,
stayed too long.
Perhaps that is a viewpoint, but I think when it's clear which way the economy is going, that's a good moment for the Fed to be preemptive.
So what would be the flashing red signals? What would you look to? Is it the stock market? Is it, or what are the indicators that you watch most closely to think, okay, here's telling me what the real heartbeat of the country is?
Yeah, it's really in the real data. I mean, the stock market, I grew up in the market, so I pay attention to the markets, but I pay attention to the markets now because of what the impact they're going to have on individuals and businesses and those signals that they're going to take. So as a policymaker, it's really more about how do the markets impact the real economy rather than the markets themselves.
So, but what real economic numbers are the hard data that you're watching? What's one or two or three numbers that would be the most flashing?
I mean, unemployment
signs?
We look at, the PCE numbers, the CPI. I mean, all the big indicators are ones that we look at.
But those take a while.
Those take a while. Look, you can look at other things like shipments that are coming in that are kind of faster, more real-time indicators. There are a few of those that we can try to track.
One of the things I know that you watch are what's happening inside the financial plumbing. And that was one of the things that, I guess that's how I first got to know you, was in the middle of the great financial crisis as you stewarded Goldman through some of that, or helped steward Goldman through some of that craziness. What did the last couple of weeks look like to you?
So again, I'm a policymaker. I'm not a market participant, but I did have a number of conversations. You know, my staff and I, we try to reach out.
There were
and make
things
sure
you couldn't help from looking at the time.
Yeah, I mean,
how did it look? Did it look like there were issues out there in terms of the plumbing? Were things clearing in a way that were not clearing in a way that made you nervous?
It looked like there was a lot of volatility in the markets, and anytime you have a lot of volatility, position sizes need to come down. Because if you have a position of this size with this kind of volatility, when you have this kind of volatility, all of a sudden the risk that's in that position is so much greater. And so you need to adjust your position. So again, not a market participant, but from what I saw at the time, what was happening was people trying to reduce their positions, trying to pare things back to get to a more reasonable level, given the volatility in the market. And things were moving, things were transferring. And that's what you want to see in a healthy market, is you want to see that risk transfer can happen. And I think we did see that. I think it felt, you know, it felt like a big shift from where it had been a few weeks before. But I think in line with the level of volatility we were seeing, that was solid market.
Some people are still arguing we're restrictive. Some pretty well thought of people based on where the 2-year is. I used to think we were restrictive, and then we'd get a Friday jobs report, and it's like, oh my God, it was just the little engine that could.
We are a very resilient economy.
Is it still like that? Do you think that all of this hand wringing with the growth worries every first Friday of the month, we're going to say not yet, and then we wouldn't be too restrictive. We'd probably be just right.
Again, this is why I'm thinking in scenarios rather than a base case, because I think there are a lot of different ways that we can go from here. One of the things that we hear about the labor market from people that we talk to in the districts is there is this hangover from the pandemic where businesses really don't want to let their employees go because they were so hard to find. It took them so long to train them and develop them that they are really holding on to them as much as they can. And that may help support the labor market as we're moving forward.